Hi, welcome back. So we have been talking about how to value an asset for these past 7 to 8 videos. So in this video, we will be starting with how to create value. So we will be talking about fundamental concepts like scale that will allow you to understand how to scale up a company, fractals, power laws, and so on. And then we'll see how we can combine these concepts that might allow you to make better decisions in the future. So we decided, why don't we start with a very interesting question? VC investment versus family offices, which is better? I wish I had an easy answer to this, but let me ask you a question. What stage are you in, right? This is a very important question because depending on the stage, it will help you to make a decision which is a better decision. So let me give an example. Imagine you started with an idea or an experiment, or let's say you are looking for a seed investment. At this early stage, I don't think it would be wise to reach out to VC investments. Although I mean to say, knowing them, meeting them is perfectly fine, but getting an investment at this stage is not that good for the valuation purposes because VC investments are very expensive, right? So you don't want to give away a lot of value in the beginning. So the first step is to start with mostly, as you already know, 3 Fs: friends, family, and fools. That will also allow you to demonstrate your skin in the game, your commitment, and so on. And then slowly you can move out to family offices, and maybe in Series A and so on, you might reach out to VC investments. It depends on, of course, case to case, but in general, you shouldn't start with a VC investment at very early stage. Okay. Now let's talk about the advantages of having VC in your company. Now, one of the biggest advantages that you could have is the due diligence check-in. So once the VC invest in, they will perform a lot of due diligence. That is going to help you a lot in the future. Let's say you're planning for an IPO 3 to 4 years down the line. Given that you have VC in your team, implies that there is a lot of due diligence, and the institutional investors will be will be at ease to invest in your company. Okay. Another important point here is that VCs do have a lot of good connections with pharmaceutical companies and so on, or let's say with stakeholders in life sciences. So that will increase the probability of getting a better exit in terms of licensing or M&A deals, for example. This will also increase your probability of getting more funding. It's like success breeds success, right? So once you have a VC in your team, that might also attract other VCs to join as a syndicate. And in the future also, if you're raising Series B, things will get much easier. Okay, then you are only focused on business angels and family offices. Another important point is that if you decide that you want to have only business angel and family offices, right? It is also important to understand how capital intensive you are. Let's say you have to raise 40-50 million in Series B, for example, and you have started with family offices. You need to have a right balance of the valuation, because it could be a possibility that, let's say you're very happy with the evaluation of pre-money. It reaches 40 million, 50 million pre-money valuation. But at that point of time, if you want to raise money through VCs, it will be very tough because half of the VCs won't be able to invest, because it will be very expensive to invest at a pre-money valuation of 45 million, 50 million euros, right? So, and last point to add is that, of course, you might get very smart brains as well. It's a smart money kind of to have VCs in your team. Now let's talk a little bit about disadvantages, or let's say cons. Okay. Now, one of the cons that I always get it from the founders is they would like to have a control. Okay. Now, as we discussed in the beginning, VC money is expensive. So of course it will come with certain clauses like liquidation preference, tag along, drag along, and so on. Okay. So here you have to see what is the payoff. Okay. Does it make sense to have VCs in the team or not? Okay. And what is the payoff? There is always a risk asymmetry in any decision making. Okay. Second point, what I would like to make also is that what type of VCs you should be having it. Okay, so now that also depends. I mean to say, if I have to look at it, imagine um, if there was a biotech entrepreneur who sold his company, he's now a VC. That would be an excellent fit. Why? Because he will bring a wealth of information about how to create a company, how right, and how to scale it up. And now he's a VC, so that would be a fantastic one as well. So looking at the track record and finding out if it is the right fit for you is very, very important, right? I remember one of the founders from US contacted me asking me that he has received a term sheet from a VC who wants to invest in, but wants to go IPO in just 1 year. Well, I didn't know the specific situation, but I think that's a short-term view in my personal opinion, right? So now let's talk about some of the cons of family businesses. Now, what I see, one of the cons is that if they are in the board, most of the time they are passive. Okay, there are always exceptions, but most of the time they are passive. So what happens? Now, our human brain is not wired to listen to disagreements. That means it's very nice for the CEO because he will be coming, presenting it, and there will be nobody to ask him tough questions, right? So that could lead to a poor corporate governance. So to have a strong corporate governance in your team, I think you need a board independent that will ask you tough questions, right? And I think in that particular regard, I would rate VCs higher than family offices, in on a general basis. Okay, as I said, exceptions are always there. Okay, um, and I think that is it. So to conclude, which is a better investment? I think there is no right or wrong answer. It depends on the stage of your investment, how capital intensive you want to be, what's your business model of your company, right? And most importantly, you have to see the risk asymmetry. If you combine all these things, I think you'll be able to manage value well, have the right people in your team, and that would help you to scale the company. Okay. Thanks for watching, and I'll see you in my next video. Thank you.